Look, I think the stock is worth $24.33. And I know that sounds crazy, but I'll tell you this. When Tilray was at 300, I think we had like a $40 target. And people said, you're crazy. When SunEdison, which went bankrupt, we had a buy rating at 30. They did this deal with Vivint, and we took our $30 price target down to $1 when the stock was 19. People said, you're crazy. And First Solar, I remember this is back in 2009 when the stock was like $230. I think we had a $40 price target. People said you're crazy. Look, I think that's what the stock is worth. When it gets there, we'll reevaluate. But I think there's a lot of issues which we...
If, like every Tesla bull out there, you're waiting to take advantage of the plunging stock price and load up more on Tesla shares, then this recent statement from Tesla's biggest bear may be something that you don't want to miss out on.
I think are pretty aggressive.
What kind of volumes are you thinking?
I think we have them getting to like 10 million.
Okay, so you actually have them getting to 10 mil.
Right.
But your DCF is still putting them at 24 today.
Correct.
That's scary.
Right, because the thing is, think about this, right? So Tesla did what, 73 cents in Q1. Yeah. You multiply that by 4 and divide it into the stock price today. You're talking about just under a 60 times multiple, right? The industry trades at 7 times. This is for a company who effectively cut prices roughly, I think it was like 10% in Q1, yet saw volumes grow just 4%, right? That means they're cutting prices and they're not seeing the elasticity. Think about this. What if Lamborghini cut their prices by 20%, right? Or forget about Lamborghini, Porsche. Or you understand, people would be running to the dealership, right? If that $200,000 Lamborghini, the elasticity would be massive. So the issue with Tesla is very simple in our view. You have a company who, over the past 4 quarters, has produced more cars than they've sold. That's a record. You have a company who's cutting prices, and you're not seeing the same increase in unit volume that you're seeing in price cuts. That's a big problem. You have a company who, in our view, is the BlackBerry of EVs, i.e. they're the first guy out there, but now you have all these guys coming in with cars that have equal or better real-world range, better interiors, and real service ability, and a long history of being able to make it. Tesla's never been through, it's a frontier asset essentially. They've never been through a full business cycle. So I just think that there's significantly more downside because you have all this competition, and it's not necessarily Tesla's fault, right? Think about this, right? The cost of capital.
While several analysts believe that Tesla is not just a car company, Gordon Johnson thinks that with time, these analysts will realize that Tesla is all it can be. Johnson believes that the competition is closing in on Tesla, and the automaker will likely respond very soon. Will this turn out to be the case? Well, we're about to find out. Hey guys, welcome back to Tesla Tomorrow. Earlier this year, Johnson argued that Tesla's lead times and backlogs have dropped dramatically, revealing a demand weakness. According to him, Tesla's real issue is a long-term growth problem that makes its current valuation illogical. Gordon Johnson stated that Tesla is a company that's valued for tremendous growth, at around 2 times Toyota. He cited that Toyota sells 11 million cars a year, while Tesla sells 1.3 million cars a year, adding that if Tesla is valued twice as much as Toyota, then the EV maker should be growing significantly. Johnson argues that Tesla stock will fall to just $24.33 per share by the end of the year, as investors realize that it has built too much capacity. Maybe this is true, and maybe it's not, but we'll get into the details in just a moment. Before we start, if you like this type of content, hit that like button, subscribe to our channel, and turn on notifications to keep up to date on everything going on with Tesla. It is important to note that while Tesla's falling net profits may have disappointed some investors, the most intelligent investors already see the big picture here. Tesla's strategic move to become the lowest cost producer in the EV industry is a long-term play that may hurt its results in the short term, but should produce tremendous benefits for the future. It's obvious, though, that short-term pain in exchange for long-term gains clearly is Tesla's game plan here, and investors should probably think along those lines as well. After Tesla reported its first quarter results last month, the market seemed dissatisfied with the EV maker's falling margins and net profit. Still, there are also other important takeaways from Tesla's report that savvy investors paid close attention to. After seeing what Tesla did last year, when revenue rose by 51% and net income more than doubled, investors hoped for similar results in 2023. Unfortunately, as Tesla repeatedly cut the prices of its EVs, they were disappointed by the consequences: a slower revenue growth rate of 24% and a 24% decline in the net income in Q1. Although nobody likes to see the net income of a company in their portfolio fall, investors should look beyond the headline numbers to understand Tesla's recent strategic shift. Despite the challenges, though, Tesla remains optimistic about its long-term prospects. The company reiterated its target of delivering around 1.8 million vehicles in 2023 and highlighted its ongoing investments in battery factories and efforts to normalize raw material and logistics costs. Tesla also expects its operating margin to remain the highest among volume original equipment manufacturers. The idea here is simple. Tesla is reducing its EV prices to improve affordability. An increase in affordability will help the car company grow sales volume and expand its economies of scale and operating leverage. In turn, this is going to help cut and reduce the unit cost of production further, allowing it to cut its EV sale prices further too. This virtuous cycle of falling costs and production and rising sales volumes is going to help grow Tesla into one of the world's largest car producers. While this strategy makes a lot of sense as a method of improving Tesla's competitive advantages over the long term, it does hurt it in the near term. For example, Tesla's revenue fell for the first quarter of 2023 compared to the fourth quarter of 2022, even though sales volumes did improve in the wake of recent price cuts. Although it will take a few years for the benefits of this strategy to fully accrue to the company, there are already early signs of success. For instance, the Model Y recently got the crown for the best-selling car in Europe and the United States, excluding pickups. Similarly, Tesla recently posted on Twitter that its Model Y AWD is the most efficient electric SUV ever built, with the model getting an impressive 4 miles per kilowatt-hour. The company shared a chart comparing the Model Y's EPA range against its competitors, and this showed Tesla's significant lead in energy efficiency. The chart in Tesla's tweets displayed the energy efficiency of various small all-wheel drive SUVs in miles per kilowatt-hour, and it clearly showed that the Model Y is in a league of its own, with competitors lagging behind. The Tesla Model Y's awesome AYD is actually really efficient, and it's got an impressive 330-mile range on a single charge, which makes it the top choice for electric SUV buyers. Tesla has succeeded in shifting the direction of the auto industry, away from internal combustion engines towards electrics and towards vehicles that drive themselves. However, its valuation has attracted enormous competition, and expectations for its own financial performance keep rising. Some rivals are copying Tesla's production technology and buying some of the same equipment that the automaker uses. But in all of this, there is very little to fear or be worried about. Tesla has established a wide lead over its rivals in manufacturing technology, an area where it was struggling some years ago. Likewise, Elon Musk himself has told investors that Tesla can keep its lead in EV manufacturing costs. Another essential thing that investors pay little attention to is Tesla's impressive balance sheet, which contains a whopping $22.4 billion in cash equivalents, and investments. That's a remarkable turnaround from when the company was on the brink of bankruptcy a few years ago. A strong balance sheet will help Tesla survive downturns in global economies. During those challenging periods, consumers will be less able and willing to buy big-ticket item cars. And so, not only does its strong balance sheet give Tesla the cushion to weather financial storms, it also provides it with the flexibility to concentrate on its long-term objectives and keep investing in expanding its market position, even during downturns. Being the best, lowest-cost producer provides ample benefits. It would allow Tesla to charge roughly the same prices as competitors and have higher profits. And it can also make more money on every EV sold via other services such as supercharging, connectivity, and autonomy. The price reductions should most likely accelerate the number of its vehicles on the road over time, and that helps the economy collect more data to feed into its AI systems to further advance its autonomous car projects. Besides, as Tesla continues its initiatives in areas such as autonomous driving, robotics, and renewable energy, it will need substantial financial resources for investments. a solid balance sheet is even more crucial for the company if it is to successfully implement its ambitious plans. Tesla's car models are already doing incredibly well, and despite economic constraints, demand is still in top gear. The automaker recently highlighted the fact that the total cost of ownership for a Model 3 rear-wheel drive over just 5 years is similar to that of a Toyota Corolla. While the price of the Model 3 is similar to that of the equivalent BMW or Audi, Tesla stated that over the lifetime, running costs of EVs are lower than those of ICE vehicles, due to the lower maintenance costs, cheaper electricity, and the higher residual value of used Tesla vehicles. Tesla said that the total cost of ownership over 5 years, or 60,000 miles for a Model 3, is 49 cents per mile, while a 2023 base model Toyota Corolla is 46 cents per mile. This means that the Toyota Corolla total cost of ownership is just over 2 cents per kilometer cheaper than that of the Model 3 over 5 years, equating to a $2,000 difference over 100,000 kilometers. Many people think that EVs are just too expensive, but the ticket price or upfront cost is just one part of the picture. When you factor in fuel costs and maintenance over the lifetime of the vehicle, the economies of car ownership is starting to go in favor of EVs. As the electric vehicle market continues to expand, Tesla will still stay focused on efficiency, which is good for consumers, the environment, and the company's margin. This should also help the automaker with its aim of becoming the EV cost leader. Do you share these thoughts? Let us know, and don't forget to tell us what your valuation of Tesla is. And if you want to keep up with everything going on with Tesla, well, don't forget to click on one of these next videos on your screen. See you there.